back to this week's market update. Today is Monday, June 9th, and we'll jump right in. The market continued its V-shaped recovery from the tariff shock of early April, boosted by a stronger than expected jobs report from May that came out on Friday last week. As of Friday, June 6th, the Nasdaq Composite rose about 2.2% last week, followed by the S&P 500 up 1.5%, the Dow Jones Industrial Average up about 1.2%, and in the bond market, the Barclays Aggregate Bond Index fell about 0.8% last week. Heading into our economic news from last week, the May jobs report came in better than expected on Friday, lifting stocks and providing a dose of optimism amid some mixed economic indicators. We saw non-farm payrolls come in higher than expected at 139,000 jobs added in the month of May compared to the 125,000 that were expected, and those jobs largely came from healthcare, leisure, hospitality, and social assistance, while we saw federal government employment drop by about 22,000 jobs in the month of May. The unemployment rate stayed stable for the third month in a row at 4.2%, which was slightly stronger than expected. And we saw average hourly earnings up 3.9% from a year ago, outpacing inflation. So some real wage gains there. And then lastly, the average work week held steady at 34.3 hours for the third consecutive month. Despite the overall pretty steady outlook in the employment report, we did get another weak month of the ISM Manufacturing Index, as well as a weak month for the ISM Services Index. So it came in at 48.5% in the month of May. Anything below 50 is considered bearish, while anything above 50 is considered bullish or expansionary. So coming in slightly lower than it did in April, that is another month of bearish reading for the ISM index here. The downturn was driven by falling inventories and new export orders, while prices improved but continued to reflect an inflationary environment. On the other hand, modest gains in production, deliveries, and new orders helped to partially offset the weakness in the index. So manufacturing continuing to be a pretty weak spot of the US economy. Along with that, the ISM Services Index came in slightly bearish for the month of May at 49.9%, signaling a small contraction in the services sector for the first time since June of last year. The decline was driven by weaker business activity, softer new orders, lower inventories, and a reduced backlog. On the other hand, increases in employment, deliveries, and inventory sentiment helped to partially offset the weakness, although we did get a pretty big drop month over month here to a negative level, although it's relatively neutral given that it's just 0.1 away from the neutral level. Overall, though, this with the weakness in the manufacturing sector, not a great sign, although it could just be 1 month of contraction after several months of positive readings. Looking more broadly at our recession indicators overall, many of these are leading indicators, meaning that they aim to get ahead of measuring economic downturns. We currently have 5 bearish indicators and 3 neutral and 0 bullish indicators, so it has gotten increasingly bearish here on our recession dashboard, although other current data like the May jobs report continue to show stability. So kind of a mixed bag of indicators. This could just be a growth scare like we saw in 2022, and we had a lot of negative indicators, but no actual recession come out of that period. However, it could also be the start of a very shallow recession, as we did see negative GDP growth in the first quarter, although that was dragged lower by a surge in pre-tariff imports. So a lot of things at play. We're continuing to watch the indicators, but just wanted to keep you in the loop as we do see an increase in bearishness among these economic indicators. Last but not least, Tesla sold off last week, down as much as 14% in one day, as CEO Elon Musk and President Donald Trump exchanged some heated comments on social media, with Trump suggesting that the government could halt all contracts with Musk's companies. With this recent volatility, you can see the stock is down. It did rebound a bit on Friday, but still year to date down about 30% as of Friday last week compared with the overall markets, the S&P 500's 1.5% gain year to date. That concludes this week's market update. We really appreciate you tuning in, and we look forward to providing another update for you soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.